As we head into the new trading week, the U.S. markets are currently closed for the weekend. Tilray Brands, trading under the ticker TLRY, finished its most recent session on Friday, November 14th, 2025, closing the day at 1.08 USD. It was a weak finish to the week, with the stock falling about 4.42% during the regular session, and it even ticked down a fraction more in after-hours trading to hover around 1.07 USD. When most investors see a stock price like 1.08 USD, especially for a name as well known as Tilray, the immediate assumption is one of failure. The common belief is that this is just another broken, cash-burning cannabis company, a relic of the 2021 market mania that is now slowly bleeding out while it waits for U.S. federal legalization that seems perpetually just over the horizon. The expectation is that this is a story of debt, dilution, and disappointment, but the reality of what Tilray is today is profoundly disconnected from that common belief. The 1.08 price tag is misleading. What if I told you that this company, which everyone assumes is hemorrhaging cash, just posted its first positive net income in a very long time? In its last quarterly report, filed in October for the first quarter of fiscal year 2026, Tilray reported a net income of $1.5 million. It's not a huge number, but the simple fact that the number was positive, rather than another massive loss, is a fundamental shift that the market, by pricing the stock at 1.08, seems to be completely ignoring. The company also reported record first-quarter net revenue of $210 million. So the central tension is this. Why is a company that just posted a profit and record revenue trading like it's on the verge of collapse? The answer is that Tilray is trapped in a narrative it cannot control. It is being judged not on its actual business performance, but on the failures of U.S. politics. The stock is being held hostage by the stalled, indefinitely postponed administrative hearings at the Drug Enforcement Administration regarding the rescheduling of cannabis to Schedule III. Every day that passes without a final ruling from the DEA, the entire sector, including Tilray, gets punished. Furthermore, the market is now digesting a brand new risk. Just last week, Tilray itself put out a press release condemning a new government funding bill, H.R. 5371, which aims to close the loophole on intoxicating hemp products like Delta-8 and THCA. This was a small but growing segment that many, including Tilray, were exploring. Now, that door is being shut. So while the company's core business is showing signs of stabilization and even profitability, its stock is being attacked by two different regulatory fronts in the U.S. Friday's trading action, that 4.42% drop, shows this tension perfectly. The good earnings from October are old news. The current news is the regulatory gridlock. The stock tried to rally midday Friday, hitting 1.12, but it was beaten back down to 1.06 before settling at 1.08. This is not fundamental trading. It is sentiment trading. The algorithms and day traders are in control, and the sentiment is sour, driven entirely by the lack of a U.S. catalyst. This brings us to the short-selling story, which is mandatory to understand when looking at Tilray. This stock is one of the most heavily bet-against names in the entire sector. According to the most recent data, there are over 100 million shares of Tilray currently held short. That is a massive position, representing nearly 9% of the company's entire float. The expectation is that this must be a powder keg, ready for a squeeze. But the reality is once again more complicated. The short thesis is clear. They are betting that the Q1 profit was a one-time fluke, an accounting anomaly. They are betting that the core Canadian cannabis market remains a low-margin disaster. They are betting that the company's significant debt load will force it into more and more share dilution, crushing existing holders. And now they have a new tailwind, the hemp crackdown, which removes a potential avenue for growth. What's most telling is not the size of the short interest, but the cost of it. The short borrow fee rate, which is the interest shorts have to pay to borrow shares, is currently very low, sitting at under 1%. This is a critical piece of data. It means that despite 100 million shares being short, it is still very cheap and very easy to get shares to short. The shorts are not scared. They are not being squeezed. They are comfortable. This is an actionable insight for anyone watching this stock. Stop just looking at the short interest percentage. You need to watch the borrow fee rate. If you ever see that fee spike from 1% to 10, 20, or 50%, That is the signal that the shorts are beginning to feel pain and a real squeeze could be in play. Until then, the shorts are confident. We also have to talk about fails to deliver, or FTDs. This is a topic that lights up Reddit forums. FTDs are when a seller, often a short seller, fails to deliver the shares they sold by the settlement date. Looking at the data from October, around the time of the earnings report, Tilray saw some massive spikes in FTDs, with millions of shares failing to deliver on certain days. Now, while this can be a sign of clerical errors, persistent and high FTDs are a red flag for retail investors, who often interpret it as a sign of naked short selling, where shares are sold without ever being properly borrowed. It's hard to prove, but the data confirms it was a significant issue just a few weeks ago, adding to the sense of market manipulation that many long-term holders feel. What's your take on the 100 million shares short? Is it a smart bet against the company's debt and the political gridlock, or is it a powder keg waiting for an eventual Schedule III match? Let me know in the comments. To truly understand this, you have to stop thinking of Tilray as a pot stock. That's the old narrative. The reality is that Tilray is a diversified consumer packaged goods, or CPG company. The earnings report proves this. The business is now built on 4 distinct pillars. The first, and most important for its recent success, is the beverage alcohol segment. This includes Sweetwater Brewing, Montauk Brewing, and Breckenridge Distillery. In the last quarter, this segment did $57.7 million in revenue. It is profitable, growing, and has a massive distribution network across the U.S. This alcohol business is the cash flow engine that is funding everything else. The second pillar is distribution, which is mostly their CC Pharma business in Germany. This segment did $74 million in revenue, the largest of all. It's a stable, if low-margin business that gives Tilray an unparalleled logistics and pharmacy footprint in Europe's most important market. Only after those two do we get to the third pillar, cannabis. The cannabis business did $64.5 million. And within that, the growth is not where you'd think. Canadian adult use sales were up, but the real story is international sales, which grew 9.6%, led by Germany and Australia. The Canadian market is saturated, but Tilray is a dominant player in the new German medical market, which is expanding. The fourth pillar is wellness, their Manitoba Harvest hemp foods business, which is a small, stable $15 million segment. So when you look at the company this way, you see the truth. 35% of the business is stable pharma distribution, 27% is high-growth craft beer, and only 31% is the cannabis business that everyone associates with the stock. This brings us to the future outlook, which is a story of 3 possible scenarios. The bull case is that the Q1 profit was not a fluke. It's the new baseline. The alcohol division continues to grow and take market share, its profits funding the expansion of the German medical cannabis business. The company uses its cash flow to pay down debt, stopping the dilution. Sometime in 2026, the DEA finally acts and cannabis is moved to Schedule III. This doesn't make cannabis legal overnight, but it does remove the 280E tax burden, which would make any of Tilray's U.S. option assets, like its convertible notes and MSOs, suddenly far more valuable and potentially profitable. In this scenario, the 100 million short shares are forced to cover, and the stock price begins a climb back towards the $2 and $3 levels. The bear case, the one the shorts are betting on, is that the Q1 profit was a fluke. They are betting that a recession slows down craft beer sales, that the new hemp ban, HR 5371, spooks the market, and that the DEA delay drags on for another year. In this scenario, the company's debt remains a problem. Cash flow turns negative again, and they are forced to dilute the stock with an at-the-market offering at these low prices just to keep the lights on. The stock would then face a delisting warning and a potential reverse split, which is the ultimate bear case victory. Then there is the third and perhaps most likely scenario, the muddle through. In this case, the DEA does reschedule cannabis, but it's a sell the news event. The market realizes that Schedule III doesn't directly help a Canadian-based company like Tilray, which still can't sell its Canadian cannabis in the U.S. The company remains barely profitable, with its alcohol and German success just barely offsetting its Canadian cannabis struggles. The stock remains range-bound, a zombie stock stuck between $1 and $2, frustrating both bulls and bears. This brings us to a critical question for all investors. How many shares of TLRY are you currently holding, and are you betting on the alcohol and CPG strategy, or are you still just holding on for the US legalization lottery ticket? So, as we look back at that 1.08 USD closing price, the takeaway is clear. The expectation is that this is a simple failing pot stock. The reality is that it is one of the most complex CPG hybrid companies on the market. It is a company that just proved it can turn a profit, yet is priced for bankruptcy. The ultimate outcome for this stock will not be decided by its own performance, which is improving. It will be decided by forces completely outside its control, the stalled politics in Washington, D.C., and the new, unexpected regulatory war on hemp. The 100 million short sellers are betting that politics will win and that the debt will break the company before its CPG strategy can save it. The bulls are betting that profitability, even a tiny $1.5 million of it, is the first step, and that the shorts are on the wrong